Hello and welcome to the Professional Insight Podcast, episode 5. Really appreciate everyone listening. My name is Brandon Curry.
I'm Jeff Collins.
Josh Bond is just unavailable at the moment, and myself, Trevor Lindy. Technical difficulties.
Technical difficulties. Listen, first and foremost, thank you to our sponsors, Brand Boulevard, for all of your branding needs. Our guest today, I'm pretty pumped about it. I'm pretty pumped. Did you guys end up? I know you guys follow as well, and he just our guest today just released one of his most recent YouTube videos. Preet Banerjee.
You can geek out right now, eh?
Oh God, you have no idea. I'm totally geeking out. Like, borderline man crush. Why not? But no, this I've been a huge follower of Preet's YouTube channel. I'll let him. He's a couple minutes away to joining us. He's in back-to-backs today, but the fact that we managed to get him, that's why we're doing a.
Look at that side by side.
I know that's crazy. That's good job there, rookie. I like that. That's good, Rook. But yeah, that's why we're recording and going live on a Wednesday, because it just so happens that that was the only.
He's available, right? Yeah, he's available.
Well, and he's doing his. I'll let him also go into more detail, but he's doing his doctorate. He's going to be doing that in the United Kingdom. He's moving there. Like, this is crazy. So he's got a great story. But in the meantime, Trev.
Yes.
The Fed.
Yeah.
What are we at? Anything released yet on the Fed? As we're going live today, it's Wednesday, June the 15th. We're going to be hike number, I don't know how many for the...
Well, this will be the U.S., right? When we say the Fed,
correct.
For anybody listening or watching. In all honesty, I have been just swamped business-wise today. Have not even had a chance to pay attention to the news on it at all. I don't see anything yet coming up on the news feed here in Apple News. So, but they were talking about going up 0.75 of a point, 75 basis points today. And, the reality is, if they do, there's a high likelihood that we're going to follow suit and do something similar at the next meeting which is scheduled for July. So pretty.
It looks like they basically inflated the prices of the houses during COVID to distract us from the bad economy, eh? And now they're retracting it pretty hardcore.
No, and it's kind of crazy because Collins, what are you hearing on the street right now? I mean, you just posted some good listings. For anyone that's looking to move down to Niagara, I strongly suggest you follow Collins on his Book of Faces page. But you just listed a couple properties. I mean, hey, listen, the good realtors, we've been saying this before. This is going to be the test of the great realtors and the average realtors, right?
Well, cream always rises to the top, no matter what you do, right? But yeah, I listed 2 houses today. They're both flippable properties, right? But it's difficult in a market like this. So it's something as Trevor knows, I've worked with him for a long time. I aim for houses that are shitholes. I like the shitholes. I like to fix them up, and then it's a way to make some money off of it, which I really like. And I'm not saying these are that, but these are ones that if you've got a dated house versus one that clearly needs to be fixed up, and both these houses I've listed are that, but both could make you money, and both are actually better suited as if you fix it up yourself on a Purchase Plus program, which me and Trevor have done tons of times. You could make some good money even on a market where it's going down a little bit. And one's a 10-acre property. It's 1,500 square feet, a double-car garage. And the other one's a first-time buyer property at $399, which is hard to find. But that one needs $50,000 in it, $40,000 to $50,000, which we've done before. Actually, we did it with a client last year, me and Trevor. And then the other one, you're probably looking at $100,000, $150,000. But I've already got tons of people writing about it because I got a lot of builders on my site, and they all want that forever home that's 10 acres of a wooded wonderland. So those are interesting.
So are you Bondo?
Sorry, boys.
The Harry Potter room is back. I love it. I'm going there. I'm going
So Collins, what are you hearing? Like, I mean, Trevor and I, this is the kind of our world that we live in every day. We hear about it every day. You being the realtor, are you like, what are you seeing? Like, what's the comments? Are
Oh,
people,
I'm seeing price drop, price drop. It's still selling and all that, but people who are trying to maintain that price point from January, February it's unrealistic. To me, it looks like it's skyrocketing to not pre-pandemic prices, but a year ago prices right now. Now, if you hit those prices, you'll sell them, but like it's attacking every price range. You're talking first time buyer price. The problem, the first time buyer price range, we were competing forever with people who want to do a flip or investors like that, and they had such low interest rates, which me and Bond have talked about before, that they had the borrowing power. Using the equity of their own home, they could buy whatever, and then the first time buyers can't get it. Now, with the interest rates climbing pretty fast, those people aren't quite there anymore. So it's just pushing down all the house prices. The houses I found that were going 800,000 before now are low sevens, and like 1.5s. Like I'm hearing GTA is dropping pretty quick, and that kind of affects it down here. But there's still buyers out there that are jumping on some prices and not sitting back. But the more astute buyer is going to kind of pause for the cause and see if there's better deals out there. So it's a different market. It's just I prefer this market, but the transition from a seller's market to a balanced market to potentially a buyer's market coming very soon is a steep, quick transition. And there's a lot of unhappy sellers out there that may have bought already and missed the boat on their price point, or are going to have to be more realistic on what they thought. It's just, there was a lot of money that was being made there, and it's not quite there right now. So it's a quickly changing market.
Yeah, but how long do you think it's going to stick around, Jeff? That's the other question, right?
Well, I don't know, because the interest rates continue to go up, right? And every time they do that, there's an adjustment period. And there's, like Trevor was just saying before you got on, it looks like there's another one coming shortly. So
July, eh?
How does that affect it? Right?
Yeah.
It affects the investors a lot out there because they have to deal with higher prices. So, for example, for me building, we borrow a lot of private money. We get a lot of private money at 8%, which, for us isn't bad. But if those people using the equity in their buildings are going to be paying a higher interest rate, they're not going to be getting at 2.5. They'll be getting at 4.5. They're not going to be loaning it to us at 8 anymore. It'll be 10 or 12. So I've already had, I get a lot of people talk to me about opportunities of stuff that's available. And I've had more than ever before, like people reaching out with land and townhouse developments and stuff like that, and saying, "Are you interested?" I've got a severable lot where nobody would even think of offering out off the market right now. They just sell it, put it on the market, and make quick bucks. They're coming everywhere now. I love it because there's opportunities out there, but that mindset, you have to make that flip in your head that, hey, our house isn't going to be carte blanche price. It's your quality is going to happen now. So if you got a house that you want to sell and you do good work to it, it'll do it. But then people are going to say, well, is there a finishable basement on there? If there's not, that's not as appealing, right? Is there a garage on it? Is there not? Is there a driveway that looks like it needs to be dug up and redone? All these things are going to become more picky, because before, like, you could have a foot of water in the basement and people would love it and overbid on it.
Yeah.
Now if you walk in the house and there's a fart smell in the house, they're like, okay, let's get out of here. I want 50 grand off it. It's.
I don't know if I'd buy a house that smelled like a fart on any given day, but
I would 100%.
I know
Put an ozone machine in there and get rid of that fart smell. It's a fart. That's the worst thing you do. Like, joke. Here's a good joke that you hear a lot of times. If you're selling a house, huge tip: don't take a big dump in your toilet and walk out just before the showing. And
you've had people do that.
Not my people. I hope not. Like, I'm not there, but I've had it where I walk into and it like it's still steaming on the toilet when I walk in there, and you can smell it, and you're like, oh my, like spray something, like, yeah. Because I tell people all the time, when you're looking through houses, one of the big factors is we got to go see it. We got to go see it. We got to go see it. Got to go see it. And if you're doing your right job as a real estate agent, you've got to go through with your people, because you're representing. You got their best interest in mind, so you got to put your eyes on it. I always tell people, I got to get my eyes on it. So when you have people go through
agents, George, yeah, I would do that, Jeff.
What, take a dump in the toilet before the house gets shown? I hope none. I hope 0%. I'm sure there's
make sure that they take the time to take the clients.
You have to be with an agent, right? See, the difference is open houses now. People can go through an open house and say, I want to put an offer in, right? And it does happen. Like, like a very small amount. Like agents are like anyone in our business is super busy and all that. And I like to have Sundays off, as you guys know. I do lose business because I take Sundays off, but I prioritize my family at least once a week, and Sunday's the best day. They have no school. I can have some fun with friends, maybe Saturday night, and Sunday just doesn't. And I have lost a deal or two a year over the course of my career, especially when I switched them. And it is what it is. So I'm prioritizing my family and telling them every Sunday, no matter what, it's what we do, right? So there's a different rule for all that stuff. But there's agents now that can't make it there on open house because they're doing their own open houses. So people will go through, they love to go through open houses. It's a way to go fishing as an agent, right? You go to find buyers and stuff like that. I do sell houses at an open house without a doubt. Like I meet a lot of clients in open houses. A lot of them go nowhere, but that's the sales game, right? You're playing the percentages. The more opportunities you got, the better chance you got to convert. So if you convert 10%, you're still making money off it, right? But you should go through. And I've had it where agents try to buy my properties. These are agents from out of town. I'm not going to say where it is because out of due respect to one of our past guests. But from out of town, and they're like, you know what, love the house, I'm going to throw an offer. Haven't seen it. I said, no, I'm not taking it. You want to represent your client, you go through the house. You go through the house, we can do business. If not, I don't want to hear about this. And as a lawyer, you know that before on the close. Oh yeah, we didn't know that was there. Well, you didn't go through it. I don't understand how an agent would, and believe me, very small percentage of agents would do this. Okay, I'm not trying to slander this industry.
Yeah, that's why I asked. That's why I asked how many would do it.
But you hear every scenario. Like I had one where I sold recently, and I won't say the address or nothing like that, but this was an agent from out of town, wanted no matter what. I had tenants in it. Tenants, you need 24 hours notice. They need to be informed before you can go through. But he lived in the basement. So he said, I'm going to put an offer in full price. I said, no, I'm not going to take it. I don't care. I'm not going to get stuck in a problem later on where you say, I didn't know about it. Do your job and drive down here and show the house to your clients. If you're fine with that, I'm fine. He said, okay, if I can go tonight, I'll do it. I said, well, you can go in the bottom part of the house. So the basement was like an in-law suite where the owner lived there and he rented out the upstairs. And then he said he had enough of the pictures upstairs. He didn't care. He was going to gut the upstairs, so he didn't care. He liked the location, liked the price point. Took it, closed. I got a bigger deposit on it, which is a lawyer, big deposit, big deposit, big deposit. You want to protect your client. We knew about that.
Okay, Collins, we got to go.
Okay.
Collins. So our guest 100%. Is here. Preet Banerjee. How's it going?
It's going. How are you guys?
Pretty good.
Great. Thank you so much. So thanks so much for joining the podcast. We really appreciate it. So we'll do a quick intro of ourselves and what we do. And then you can go into details on your history and the background and what have you. So obviously, Brandon Curry, certified financial planner, chartered life underwriter, partner at C.R. Smith Financial.
Future mayor.
Yeah, not even close. Do not want the political game at all. Trev?
I'm mortgage broker, Neighborhood Dominion Lending Centers.
Collins?
Podcast superstar. Oh, just joking. I'm a realtor and a builder and dabbling in developing right now.
And Bondo?
I'm a husband, a father, and a lawyer at Flat Becaria.
And a hell of a golf player.
And
I can hit a decent ball, but not anywhere close to the green. No, that's cement hands.
So, Preet, your background.
Sure. How short? How concise do you want me to be? Because it zigs and zags like crazy.
Oh, just go. Yeah, I mean, like the fact that you went to school as you went to school to be an F1 driver, which is crazy. But go ahead.
Yeah. So, okay, let me go one step before that. So,
okay,
I want to hear the academics on that.
So initially, I went to school. My undergraduate degree was in neuroscience at U of T, and the day after my last exam, I started my next schooling adventure, which was at the Bridgestone Firestone Racing Academy. Which was the goal was to try and become a professional race car driver. Little did I know at the time that I started too late and I ended up running out of money and talent. So obviously that career ended relatively quickly. So it was that after that school that I realized that it wasn't going to be in the cards for me to become a professional race car driver. So I stayed at the school for 2 more years working there. And I worked in the office. And that school, that racing school, had 3 main lines of revenue. One was people who wanted to become, the next Michael Schumacher. Then there was individuals who just wanted to give it a shot, see what it was like to drive a race car. And then we also had corporate entertainment, which was really the main revenue of the school, was corporate entertainment. So you could take 144, I think, people for a scramble style golf tournament, or for the same price, you can take 12 VIPs to the racing school. It's pretty expensive to drive those cars. But by virtue of that, a lot of the corporate clients were Bay Street firms. And so I got to know a couple of people on Bay Street. One guy took me aside one day and he said, when you're done wasting your time, I want you to come work for me. I think you do really well in my world. And his original plan was for me to, take the CFA and use my neuroscience background to become a biotech stock analyst. And that was the initial plan. And then about 3 months after he told me that, he retired. And so I didn't have a sort of a place to...
What? Seriously?
Yeah, young guy too.
He must have done well then.
Yeah.
Yeah, he was one of the original investors in, I think, Netscape Navigator, if you can remember that.
Oh, yeah. I remember Netscape.
Wow.
Yeah. The old the old lighthouse, right?
Yeah, he was a pretty hotshot tech analyst, and he timed his exit perfectly. So in any case, I didn't have a spot to sort of neatly tuck into, so I took a different path and ended up becoming an advisor. First mutual funds, then I was a stockbroker. And I'm going quickly now, but... And then I spent some time as a wholesaler selling index funds, boutique index funds to advisors. And then around the same time, I was driving to work one day, and my girlfriend at the time heard an ad on the radio for the Women's Network, who was looking for on-air talent. And they were holding this competition for people to just sort of apply. And I thought she was telling me the story because she was going to apply. And I was like, yeah, great, go for it. I think it'd be awesome. She's like, no, stupid. I think you should apply to be like the money guy for the network. And, up until that point, I had no inkling, intention, or desire to be on TV or anything like that. But I decided, you know what, let's give it a shot. I never want to close a door. I don't want to be one of those people that looks back and regrets the things that you didn't do. So I said, screw it, let's do it. And so I auditioned. Long story short, I ended up making it to the final 7. The final 7, we were put on a reality TV show. And the goal was to try and find the ultimate W network expert. And it was this crazy reality show competition. We can talk about that if you want, but I ended up winning it.
Give us a little bit about it, Preet. I'm sure.
Sure. Yeah. Okay. Well, the gist of it was there were 7 different lifestyle experts and 7 different disciplines. So there was like a hairstylist, there was a chef, there's an interior decorator, a fitness person, and what have you. I think there's a psychologist as well. And so we had all these different tasks that we had to perform, which were designed to see, well, how good could they potentially be as a TV host? And so these tasks were things that they wouldn't tell us what they were ahead of time. And so sometimes you just have these big studio doors and they said, all right, so once you pass through those doors, red light is on, everything's being taped, it's go time.
On.
And we'll tell you what you're going to do after you enter those doors. So I remember one of them was you go in and you get to this like podium. There's a little table there, and on this table is this weird metal contraption. You had no idea looking at it what it was for, and they said, okay, tell us some lesson from your discipline in 3 minutes while using this to open a can, because this is the first can opener that was ever invented. And if you looked at this thing, you had no idea how to use it. So I just ended up sort of like stabbing the can while I'm trying to talk about, I don't know, compounding returns or something like that. In any case, I ended up missing the can and I sliced my hand open. I ended up going to the hospital.
Jesus.
Oh my God.
So that was one task. Another one, which was funny,
Well,
was
you
they
left
said,
an impression, Preet.
Totally. I think that actually did make an impact. Maybe they just felt sorry for me and they said, we don't want this guy to sue us. So, give him the prize. Another task was you go into this room, there's a teleprompter, and they said, just read what's on the teleprompter. You're like, okay, well, that sounds relatively easy. But the person who was operating the teleprompter was given instructions to speed up the teleprompter to a point where you could not catch up. You had to introduce this guest onto this make-believe program, and their last name had like 30 letters and no vowels. And so they were just doing things to see how fast you could react on your feet. And I think the big culminating event was this, what they called a divorce party. And they said, listen, all 7 of you are going to spend 3 days with this couple who are planning their divorce party. So it's amicable. They've had a great relationship, but they've just figured out that, the relationship isn't working. So they're going to throw a divorce party. So we need, the interior decorator to design the party. We need the psychotherapist, do some couples counseling. You got to talk about, them getting divorced and all this stuff. And unbeknownst to us, the 2 people that they had hired were actors, and we thought it was real, right? And it was emotional. A couple of people who were competing were like crying during like the final sort of scene. And then right at the end, they said, well, thank you for helping us manage our divorce. And by the way, we're just actors. We're totally madly in love. Everything's fine. And you should have seen the cast almost rioted. It was brutal. Long story short, and I think this was because I thought there was no way the money guy was going to win, this competition to become on-air talent for a TV show for the W Network. So I thought there's no chance. So I'm not going to get too worked up about it. And I think the fact that I wasn't nervous because I thought there was no chance that I was going to win is the reason I ended up winning, because I think the nerves crept into maybe some of the other competitors. It was also the time of the great financial crisis. So the timing was right because the appetite for anything financial was huge at that time. So the stars kind of aligned, ended up winning the show. And the prize was a development deal for my own show. And for about 3 years, they paid me a lot of money not to be on other TV networks. So there was a joke that I was the best paid host not on TV, because they're trying to figure out a show concept. So in the end, they just said, well, here's an existing show. You can just, become the host of that. And that was $1 Million Neighborhood on the Oprah Winfrey Network. So I ended up hosting that for a year.
Jeez.
Nice. Oh my God. So now you have a very popular, which I follow, and I tell my clients to subscribe into, or even on different things. I'll send them links and of your YouTube video. You take us to what's the YouTube channel called? I know you've got over 115,000 subscribers.
Yeah, it's just my name, Preet Banerjee. If you want to find it, stumble across it.
Now, you did what got me onto the YouTube channel initially, and I was telling you about this before, was the analysis that you did on designations and the importance of dealing with professionals. And I vividly remember that. It was one of the reasons that I went through hell to get the CFP, because I ended up writing the CFP during the pandemic because everything got delayed. And that was one of the major reasons I got the CLU as well, and my designations there. And just, we're all, we're called the Professional Insight Podcast for a reason. We just felt that we shared a lot of information, like Trevor and I, with interest rates going up, and then that linked to Collins, and I obviously have clients saving for real estate, and then Bondo with all the legal expert. And yet people still try to do it themselves or think that they're better. And I guess coming from someone who has done it for quite a while, how maybe some advice for people or some insight into, we're going to touch on crypto, we're going to touch on self-investing in the apps, but let's just ease into that and the importance of dealing with professionals and your opinion on it.
Sure. Yeah. So let me take a step back and also point out that looks like the Fed raised by 75 basis points.
They did.
Yeah.
Just hit the wire.
Yeah. So let me take a step back. And one of the things I didn't mention in my intro is that I went back to school to pursue a doctorate. And my research question is looking at quantifying the value of financial advice across different delivery channels. And so I started blogging back in 2007 and sort of just opining on different things related to personal finance and advice. And the early days, people thought that it was kind of paradoxical. I was an advisor and I was writing things that made people think that I was anti-advisor. And I think people always trying to put people into a box and try to figure out, all right, so what's their sort of worldview? And when it comes to advice, I think there are people who are very firmly in the pro-advice camp, and there are people who are very anti-advice camp, especially in the when it comes to investing. And that's that one-dimensional way of looking at things never really sat well with me, because and I think a lot of people agree, there are some people who can do a lot on their own and they're capable of doing a lot on their own. But the vast majority of people need some form of advice. And there's also two sides of the equation in terms of relationships. You have the professionals or salespeople, and there's a huge variation in quality um, in on the advice side. And there's a huge variation in the type of client as well. Some clients are great clients. Some clients are not great clients. And so really what I wanted to do is try and take a look at how do we align people so that the consumer ends up in the best place for them. And sometimes you'll have people who can benefit greatly from professional advice. And sometimes you'll have people who benefit moderately from great advice. And sometimes you'll have people who can do pretty well on their own. And some people who will only do it on their own and also end up shooting themselves in the foot. So there's so many different sort of combinations. And you have the client's perspective and you have the advice giver's perspective. And if we sort of paint each side as homogenous, it's just not reflecting reality.
Right. Now, it was just interesting. So, how are you going to do that? That doctorate, you're going to be moving to the UK to do that study. How are you going to quantify that? Like, what are you going to do? Are you going to look at returns and then compare that to a control study? Like, what's the methodology? I guess is what I'm getting at.
So the study is actually done. I'm moving to the UK because my partner, now fiance, is.
Congrats.
Thank you. Her life is there and has been for a long time. And so I'm only moving there because her career, I think, is more important than mine right now. And I'm also much more flexible. I've been working from home for like 10 years. So so the study's done. This is like year 6 of the study, of the research. And so I can tell you exactly what the design was to try and answer that question. So first, it's a moving goalpost situation in terms of what is actually being provided. So, if you go back 60 years, investment advice was really just transactions. People tell you what stocks to buy or sell. May 1st, 1975 is known as May Day in the industry. So this is a pretty auspicious day, May 1st, 1975. This is when the SEC, the Securities Exchange Commission, deregulated stock trading commissions. So up until that time, it didn't matter who you went to or how big your trade was. Trading commissions were fixed, right? It was a completely regulated industry, which is kind of ironic considering it's the US, the hotbed of capitalism, the most capitalistic industry, Wall Street was completely regulated. So May 1st, 1975, that all changed and people thought, this is going to be the end of advice. And it spawned the growth of discount brokerages, allowing people to either get big discounts on their trading commissions or potentially do it all themselves over the phone. And the industry responded. So they responded by not just providing transactional advice. They switched to portfolio management and saying, well, how do these different components of your portfolio work together? And how do we think about that more holistically? And then as portfolio management has become more commoditized now, we see, think about the advent of portfolio funds, all-in-one ETF solutions, robo-advisors, index, whatever it is, it's now a margin compression game on portfolios. And spending a lot of time trying to build a better investment mousetrap is not the greatest use of time for most professionals because it is completely commoditized at this point. And so the value proposition of advisors has shifted away from portfolio centricity towards planning centricity and financial wellness. And so part of my research is trying to make sure that the gauge for the value of financial advice reflects contemporary measures, which is taking a look at how contemporary financial advisors, the good ones, are providing advice. And they're doing it on a holistic basis, which means not just looking at the portfolio, still a consideration, but also looking at things like their life insurance coverage, their disability insurance coverage. Do they have an emergency fund? What's their, their
Critical
debt
illness.
servicing ratio? How do they manage their credit overall? What about education savings, estate planning, wills, powers of attorney, and so on and so forth? So there's multiple facets of wealth. But here's where it gets really tricky. So, as a conceptual sort of model, here's how you can think about it. Each of these factors of wealth have varying levels of importance to people depending on where they are in their wealth journey. So let me give you an example, a very simple one. Disability insurance. If most people probably know that their single biggest asset when they're young, especially, is their ability to earn an income for the rest of their life. That's worth millions and millions of dollars. And if everything goes according to plan and you're able to earn that income over time, you slowly convert that into assets. Some of it is spent and so on. But when you're young, that is your single biggest assets, your human capital, your future as of yet unearned income. And so if you don't protect that with disability insurance and you become disabled and unable to earn an income, any plans you have go out the window. You are now guaranteed to be broke or living off the charity of others if you become, totally disabled. And so having disability insurance is really important if you're young. So if you're 25 years old and you don't have adequate disability coverage either through work or privately, that's a big deal because your life can get completely derailed and there's no coming back from it. If you're 64 and everything else is in order, you've been saving enough, your taxes managed appropriately, maybe your house is mostly paid off at this point. If you become disabled at 64 1 year before you were going to retire, it's not really a big financial deal. Emotionally and physically, of course, it's awful, but it's not really a big deal to your financial plan. You're very close to being retired anyways. You've built up your assets. You're effectively self-insured at this point. So the importance of whether or not you have disability insurance, as an example, is really important when you're younger with most of your income to be earned in the future. And it's not super important when you're 64, and it's probably unimportant when you're retired, assuming you're retiring and living the lifestyle that you want. So what that tells you is that one factor, the importance of that factor in your overall, call it score, varies in its importance. And other factors of wealth also vary in their importance depending on different things. So, for example, the cost on your portfolio to manage your portfolio. It's not related, it's not sensitive to your age. There might be a correlation because people tend to amass wealth over time. But if you inherited $10 million at 25, your portfolio costs are important. But let's say you only start investing at 64 and you start investing, I don't know, $50 a month. Even if you had like a 3%, 4% MER portfolio, it's what, like, I don't know, 15, $20 in fees in that 1 year. So it's not really that big of it. It's not ideal, but it's not really that big of an impact in your financial potential. So for every factor of wealth, life insurance coverage, disability, emergency fund, all that stuff, you have to figure out what are those factors sensitive to so that you can figure out, well, how important is it for this person depending on where they are in their journey? So if you could take all those factors and all those sensitivity loadings and then come up with this one normalized number, you could, in theory, go to anybody and say, on a score of 0 to 100, based on people like you in the same spot in their financial journey, you've got a score of 90, 70, 30, whatever it is. You can tell how well you're doing based on where you are, which means it's possible that someone who doesn't have a lot of money, but they're 20 and they're saving 10% of their income and everything else is they're doing what they can at that age, they might have a really high score. It might take a while for that to turn into wealth down the road, but they're doing everything that they should be doing to get there. And it's possible that you have someone who's 60 who hasn't done a lot of those things and their score could be very low, even though they might have, maybe a sizable TFSA, but everything else is not sort of lined up. So in any case, what it means is, you could in theory give everyone this normalized score out of 100, which tells you how well they're doing at that point in their financial journey compared to other people like them. And then you've probably seen a lot of studies that say, people with financial advisors have more money. And I don't think anyone disputes that, but a lot of those early studies were purely correlation, and correlation does not mean causation. So what I mean by that is we know, because of the way the industry was set up, that you don't go after people unless they have money, right? So there's a selection bias,
Unless
and there's
you want
also
a small paycheck, right, Preet?
yeah, that's right. And the flip side of it, if you're a consumer and you don't have a lot of money, you're maybe not really seeking that much financial advice. So there's a selection bias, and the real question is who is responsible for people accumulating more money. And so if you could, ideally, I would want to create something called a diff and diff study, a difference in differences, to try and tease out causality. So what a diff and diff study is you want to see how does that number, that sort of normalized number out of 100, call it, how does that number differ over time based on the different type of advice that they get. So for example, if you could take everyone who's got a score of say 50, and after 10 years, measure how does that score change depending on if they go to a full service advisor, if they go to maybe just a mutual fund sales rep versus a robo advisor versus doing it themselves. And so to cut to the chase, let's just compare two channels. Let's say you have a really good financial advisor who's holistic and planning centric versus, let's say, a robo advisor, and we'll call it robo advisor 1.0. So of all those different factors of wealth, maybe a really good advisor is going to say, hey, listen, you told me that you want to invest $500 a month, but you've got 10 grand in credit card debt. Let's pay that down first. And then we can talk about what is the appropriate amount to save. Let's make sure you got the right life insurance, disability insurance, your emergency fund is topped up. You've got an education savings plan. Let's take a look at your wills, powers of attorney, et cetera. So across a number of different wealth factors, they might increase your scores along those factors a certain point. And so maybe their overall point change, let's say for argument's sake, is, 20 points. They go from a 50 to a 70. That same type of person goes to, let's say, a robo-advisor, and all that robo-advisor does is say, okay, you want to give me $500 a month? Great, let's put it into this portfolio. And that's it, right? All they're doing really is asset allocation and execution. And so all those other factors of wealth, the point change might be zero because the first generation of robo-advisors don't do anything other than asset allocation and execution. And so the overall point change might be, 5 points, 7 points. And so when people say now, okay, well, a full service advisor is twice the cost as a robo-advisor, that's all they look at now because the only thing they have as a point of reference is cost. And they have no framework for value. So once you do establish a framework for value, you might be able to say, oh, okay, well, I got 4 times as much value in terms of point change versus the channel that was half expensive. So the calculus changes. And so at the end of the day, what this is really doing is trying to create a framework for measuring value so that people can look at not only cost, but also what they get in terms of value, which helps them make better choices no matter what channel they end up going to.
Now, so to summarize, I mean, so the first thing is the importance of dealing with also someone who has designations as well, not just a regular, financial advisor, because, these people go to school and it's the same as a lawyer or an accountant or whatever. Like the schooling does count because you touched on a couple of things is the holistic advice, right? Otherwise, if you're just going to be doing it, just deal with a robo advisor, right? But the other thing is this is more of a little shot to the importance of disability insurance, Trevor Lindy, and also
you disabled, Trevor?
Well, no, he just froze.
Clearly.
Oh, there he is.
Internet keeps freezing.
Clearly.
Yeah, but then also
So
on top
frustrating.
of that, ensuring that financial plan is, because you are worth more, in your earlier in your career, you are worth more dead than alive because of the time value of money and the insurance that's needed, or the critical illness, or the disability, and the financial planning because of your future income needs. Is that correct?
Well, you're worth more dead if you have the insurance.
Correct.
If you don't,
Correct.
then
Yes.
then not. I think the point is that the value that has not yet materialized in terms of your balance sheet is
Correct.
converting that future as of yet earned income into assets. So there's a lot of potential the younger that you are, and your trajectory in life. This is when it's very malleable. Making those right choices early on can have a big impact because of the time value of money.
So on that,
from my perspective, Curry, the big value, and to Preet's point, is just the advisor's ability to kind of dissect their client, right? And give them advice in terms of, you know what, at 25, disability is a fantastic idea, right? This is something that you should be storing your nuts into at this point in time. At 60, well, you know what? Let's take those nuts away and put them somewhere else, right? Like,
Right.
you know, and I mean, to me, that is invaluable, right? For somebody who doesn't have the time to otherwise go and, try and even attempt to do what I would say a feeble amount of research to get what somebody like a professional advisor would be able to answer in relative short order.
And on that, Preet, I mean the self-investing apps like the Robinhoods of the world, just to name the one
The
to
robos,
the south. Like people, I mean, the amount of times I hear, well, it's free. It's free. I don't have to pay anybody. It's free. Listen, I'm done talking about how, this is how Robinhood gets paid. You did a great episode on it, on how they get paid. Go, because I'm done talking. I don't know. People aren't listening to me in some cases, and okay, yeah. How they
doesn't
get paid
Robinhood steal from the rich to give to the poor?
Yeah, I don't know, but
it's
go
actually, I
ahead.
think in terms of Robinhood, I think some people would argue that it's kind of the reverse in how their business model operates, in that they scalp from the lower income and give to the already wealthy. Because for people who don't know, a lot of their revenue comes from what's calling selling payment, getting payments for order flow. So when you try to route an order, normally it would go right to the exchange in the old days. But what they do is they end up selling those orders to go to market makers to execute those trades. And they basically take a cut of the spread between the bid and the ask. And they do this on such a high frequency basis and such a high volume basis that people don't really notice it. But it ends up, generating billions and billions in revenue. And that comes from getting a cut of that bid ask spread. So when it comes to execution of orders, the consumer is ending up paying for that, even though for them the execution might look to be free. It's coming out of the bid ask spread. But to your point, Brandon, in terms of what these apps do, there's been a lot of people who say this innovation of technology in trade execution is amazing. Right now, the costs of trading are zero in some cases. Well, that's separate from what's in the best interests of investors. And many academic studies have shown time and time again, one of the most famous studies, I think, when it comes to trade execution is Barber and Odine 2000 or 2001. And it was called Trading May Be Hazardous to Your Wealth, which was a play on smoking may be hazardous to your health. And what they found was when they divided up a sample of people who were trading stocks, they found that the more people traded, the more frequently they turned over their portfolio, the lower their performance was. So the more, it's kind of like that analogy that, your portfolio is like a bar of soap. The more you touch it, the smaller it gets. That's what they found, and they divided people, I think, into deciles, and the by frequency of trading activity. And the top decile, I think, had an underperformance at the time of it was almost 10% annualized. And this was a strong period of market performance where the market was up like 17 or 20% or something like that. But in any case, the more you traded, the worse you did. And what's one thing you can do to encourage people to trade more? Make it less expensive to trade. And if you want to go even further, make it free to trade. And so there's effectively no barrier to trading. So people trade way more than they would have otherwise. And so you could argue that removing all commissions is actually reducing the performance. Yes, they pay less in commissions, but they suffer in terms of higher underperformance if they are trading more often. And so that has not necessarily been a great innovation from the perspective of, the money weighted return of the investor.
Now, I want to Google that actually. I didn't know that study. What was the Barber 2001? What was it? Sorry?
It was either 2000 or 2001. It was Barber and Odine. And it was called Trading May Be Hazardous to Your Wealth. Or very similar to that. Very, very similar to that.
Yeah.
Okay, I'm going to definitely look that up. trading may be hazardous to your health or wealth. Sorry.
Yeah.
Now, can we touch on this? Will piggyback into the crypto piece? So, Warren Buffett, 91 years old. His business partner Charlie Munger, 97 years old. Obviously, you and I both revel in what those two have done in the past 50 years. As a matter of fact, I just to geek out, I basically compared. I did. I compared. Yeah, I compared Berkshire Hathaway's holdings, which is usually a 90-10 between equity and fixed income, to a 100% U.S. equity portfolio going all the way back to the late 70s. And he literally is off. You got to remember, if he's using 10% fixed income, to our listeners, that he's using 10% less gas on the fire than an ETF. It's essentially a U.S. equity 100% ETF portfolio, which is all stocks. He is only off by, in a 50-year return, around 20 to 30 basis points. Yet the amount of times I heard in the last, especially 2 years, on how famously Charlie can't stand cryptocurrency. Warren Buffett said, if I had the money, which is ironic when he says that, I would short all cryptocurrencies. And this is back when they were flying high. And the amount of people that would say, oh, they're in their 90s. What do they know? They need to get off this train. They don't know what the heck they're doing. All this going on. So it's a couple parts of a question that I want to kind of get your opinion on. One, what other industry where you've been in the industry for 50, 60, 70 years with a track record where you are not only one of the best, you are the richest person in the world, that it doesn't happen with doctors. It doesn't happen with dentists. It doesn't happen with lawyers. It doesn't happen with accountants. It doesn't happen with, real estate. No one ever says that about any other profession where they're too old. They don't know what they're doing. As a matter of fact, they become reveled and revered in their industries because they've been in it so long. Yet in our industry, we've lost touch. So if you want to touch on that a bit, it just drives me bonkers.
Yeah, I think, people are always looking for the next big thing, because part of Wall Street investing, the industry, is this romanticization of how you can create extreme wealth. And we celebrate these stories of, how someone took an idea and with a lot of gumption and perseverance turned it into, $1 billion industry or whatever. And so we celebrate, entrepreneurs. And some people say, well, this is entrepreneurship, the whole crypto space. And so they may say, yeah, you don't get it because a lot of the people who end up changing the world or innovating and advancing civilization, society in some way, shape, or form were always called, crazy at the beginning. And so part of it is separating those sort of narrative stories from fundamentals. And that, I think, is what has really defined Buffett and Munger and Berkshire Hathaway, is that they get down to fundamentals and they have a very particular investment philosophy that is simple to explain, very hard to execute for people. And I think that speaks to the emotional component of investing in general. Their process is almost, I guess it is hardwired into their psyches, that they have an idea as to what and how you value a company. And they have this idea of what that intrinsic value is of a company. And when they see prices are trading below that, they see that as a mispricing and they see it as a value play. And they say, if I'm willing to hold in this business for 30, 40, 50 years or indefinitely, and it's being, traded at a discount to what we think is its intrinsic value, we're going to buy it. And so that revolves around having a very good level of confidence in what you think that asset, that company is ultimately worth. And this is very different.
Long term, right?
Yeah, long term. I mean, there's a lot of great anecdotes you can get out of his annual letters to shareholders, but things like, if you gave an investor a punch card and only had 20 slots, which represents all the transactions you can make in a life, You would take each investing decision a lot more seriously. If the stock market turned off for 10 years, we wouldn't care because we own wonderful businesses. And if I'm willing to buy 1% of the company, means I'm willing to buy 100% of the company. And I'd be happy to do that if I believe in the company and its management and what have you. It's got a big economic moat, whatever. They've got this whole philosophy. Yeah. And it all centers around value. And we have no measure of what the actual value of any cryptocurrency is. So for them, they just don't see it. And that's why they will sort of, take this very strong stance on cryptocurrency, and why they're so negative on it is because no one has actually developed any good measure of what is a coin worth? What is Bitcoin? Yeah. What should it be worth?
Some form of regulation, right?
Well, if no one knows what that value should be, then how do you know if it's discounted to that value? How do you know if it's a buying opportunity or a selling opportunity? Yeah. You don't. There's no consensus on how to value these things. So for them, it's pure speculation. And that is what we've seen, is all these stories about anything to do with, the crypto space, decentralized finance, DAOs, NFTs, Web3. It's all this hype about, well, this is what it could do. This is what it could do. Well, do it. And that hasn't been done.
It's like a junior mining stock, eh?
Yeah, there's a huge speculation component, right? And so the trade-off is, if you take the tack that, listen, this is a speculation, which is really the same as a gamble, it could pay off if it hits big. There's a lot of ifs in that, though. And there's also a possibility that it could completely fail. You may not find anything, using your junior mining company example. And if so, you lose all your money. And so is that a rational way to invest your hard-earned money, or at least all of it? And so, it's really separating the difference between speculation and investment.
Now, the one thing that just, I guess, really kind of, I don't know how else to say it, but grinds my gears, I guess, even though every single time we go back in history, every single point, we can go to the tech bubble. Yes, technology is still around. We can go back to the tulip crisis of 1634, right? That's been quoted a bunch of times. Anytime something has produced a result without any intrinsic value, without producing anything, that thing has crashed until either regulations come in or it's just standardized, tulips and tech being that one example. Yet you point to these situations and history, like Mark Twain famously said, history doesn't repeat itself, but it certainly does rhyme. And how is it that people just don't grasp? Is it just the emotional piece that people just don't want to believe it, or they just want someone to give them their confirmation bias? What are your thoughts on that?
Yeah, it's the emotional pull can sometimes cloud us. And, if you take a look at the tech bubble, looking at it in hindsight, it was clear, right? It was clear that those valuations made no sense whatsoever. But at the time, there are a lot of people who really believed that, companies were effectively valued at, $10 million per employee, which is completely detached from any sort of, valuation metric that makes any kind of sense. When you see these measures of value that are so stretched compared to the long-term norms, you'll have some people say, oh, it looks pricey or what have you. But at the time, it's amazing how we can convince ourselves into thinking, well, maybe this time is different. Maybe this will change the world, because if it does, I could get rich. And it's a very seductive line of thinking that I think historically a lot of people fall into. And again, it's only in hindsight, in retrospect, that you also start to see just how foolish some of those things sound. And so what that really tells me, that it's much harder to separate the emotional and psychological aspects from, pure valuation methods, or being more quote unquote rational when it comes to evaluating the value of assets.
Now, when we get on to our next topic, I saw you speak and you were talking about your doctorate. I believe it was in Stony Creek, this is pre-pandemic, and I think, was it CI that you spoke at? Was it or Fidelity? I couldn't remember, but
Could have been either. I don't know.
Yeah, but I've seen you speak a couple times. Now, for full disclosure to anyone that's listening, I can't sell individual crypto. I have no direct exposure to crypto. This is personal opinion. Please seek professional advice. Would love to give you that professional advice, but nonetheless, please do so. Now, the exposures that I do have would be indirect exposures. Like, for example, if I have exposure to Tesla has, accepted in some capacity cryptocurrency. So that would be my indirect exposure. Or I do own a local artist in Niagara. He released some NFTs. I have indirect exposure through that. But I need to give that that out there because my license and designations are worth way more to me than anything else. You did a great, again, YouTube piece on crypto. And this was you did this, I think 6 weeks ago, 8 weeks ago. I can't remember, but at least that's when I digested the content.
You're talking about the crypto FOMO one?
Yes, that's exactly it. Yeah.
Yeah, that was in January.
Oh, wow. Okay. Well, then I digested it about 8 weeks ago, just trying to crush some content. When the world opened up, I had very little time. But you, great. I strongly advise some people to watch that. Okay, let's talk crypto. Let's talk your opinion on it. You had some pretty good, even the trading fees, the selling fees, the buying fees. It ends up being astronomical. So let's educate our clients on, again, what's your opinion on that? Let's go with that first.
Well, I think not clients yet.
Yeah, I think most people are attracted to cryptocurrencies because other people have been talking about it for a long time, and this is how a lot of people get interested in certain high flying investments. And when you've seen the returns that have been exhibited in the past, everyone starts to think, well, if I had only put in 1,000, 10,000 or whatever. And I forget the exact numbers from that video because I did create a long time ago, but the first sort of real world transaction where someone paid for something in Bitcoin was known as Bitcoin Pizza Day. And someone paid for two, I think it was Papa John pizzas for 30,000 Bitcoin or something like that at the time. Because each Bitcoin was worth like a fraction of a penny or something like that. And so people always say, well, if you convert that to what Bitcoin was worth at the time, those two pizzas cost, $400 million or something like that. And when you hear stories like that, you're thinking, oh, wow, if only I'd gotten in. The first thing I'll tell you is anyone who got in, when Bitcoin was, $100, $1 or whatever it was per coin, no one would have held on that long to see those gains, right? Think about just a thought experiment. Imagine you put $1,000, $10,000 into some kind of speculative investment that you really didn't know if it was going to go anywhere or not. Remember, this is the early days of Bitcoin where people really didn't know what was going to happen at all, or what it was, how it was built, the technology, nothing. Like people knew nothing about it. And say your $10,000 turned into $20,000. A lot of people are saying, you know what, I'm going to take out at least my original $10,000. So maybe they leave now the free money to ride. Now, let's say that $10,000, let's say that doubles. You're going to take out a little bit more. But what if you didn't and went to 100,000? What if it 10x'd? Then a lot of people are like, all right, well, you know what? This was crazy to begin with. It's worth 10 times what I put in. I'm going to take it all out. And so if you think that putting in that initial 10,000, you would end up with like $2 billion if you had just held on, you would not have held on. No one would have held on. So those examples of look how much money you could have made if you got in early on Bitcoin is absolute BS, because nobody, unless they forgot that they owned those coins in a computer that's in a landfill somewhere, which does happen from time to time, no one would have held on. So that's one aspect of it. The other aspect is, when people, I remember this very clearly. This was pre-pandemic. It was a Christmas party. I was out in BC visiting my parents, and we're at a dinner party, and a bunch of their friends individually came up to me, and they're all asking, because they knew me as sort of like the money guy. They're like, I'm thinking about buying Bitcoin. I'm like, okay, here we go. The very next question is, what is it? I'm like,
Yes.
this is the worst way possible to consider an investment. Is I'm thinking about buying something. I have no idea what it is, but I'm willing to put in, 10, 20,000. That's ridiculous. And what this tells you is that this is really being driven by the returns, the performance. That has nothing to do with people's understanding of it. Now, don't get me wrong. There's a lot of people who work in crypto who clearly understand some of these fundamentals. But I forget who it was, but they described sort of the cryptocurrency world as everything you don't know about economics combined with everything you don't know about computer science, something like that. And these are two very difficult, topics to wrap your head around individually, but then trying to have expertise in both, that's a pretty rare combination. And so sometimes you'll find that there are people who are more technically proficient who don't understand the economics. And sometimes you'll find there are people who understand the economics and don't understand the technology side of things. And therefore, there's a lot of confusion, misinformation, and there's a lot of grift because whenever there is something that is confusing and has high possible returns, there's people out there who are just aching to make money off of it no matter how it pans out. And unfortunately, there's been a lot of that.
Yeah, it is absolutely insane on the amount of people that obviously I err on the side of don't know how a hammer works, don't know how a computer works, but I understand the economics of it, right? I mean, that's just in what we do. And I can't even tell you how many conversations I've had with clients and with friends and well, then what's the intrinsic value of it? And then they look at me and go, what does that mean? And I'm like, if you can't even explain what intrinsic value means, then why are you investing in something?
Yeah.
And it just is, it's crazy. At least, we always had a debate. I mean, this is before Elon, and which was again another episode you did, which was Elon purchasing Twitter and explaining on how that all worked. That was actually a quite funny episode.
Thanks.
And I laughed. It was good. And you could sit there and we just couldn't understand the valuation of Tesla at the time. We're going back, let's say 8 weeks, when it was over $1,000 a share. But, people would say, well, yeah, they'd rebut and say, well, I don't agree that Tesla's $1,000 a share. I said, but then I turn around, I'm like, yeah, but he by law has to release audited financial statements that I, as an investor or as a broker or whomever, have access to and can analyze and read through. And then after reading through those documents, I can then come to the determination of whether I agree or disagree that the intrinsic value within those documents justifies the share price. Bitcoin doesn't have any of that. Cryptocurrency, so I should say, has none of that. And I think that's just so scary. I mean, I was down at a client's place. Won't say where specifically, but just, and, these clients are in their 60s, modest, cute little home, nothing too crazy, but still working in their 60s. Will probably have to work a little bit longer. And after the conversation, they were coming into some money, but nothing, I'm talking $10,000, $20,000, which was a lot to them. But nothing on the grand scheme of things. And he literally deadpanned to me and said, and I quote, I'm thinking of getting into crypto, specifically the Don Cherry cryptocurrency. And I mean, I couldn't tell them, no, don't walk, run. Now, this is before the whole Poppy situation. And
right.
Before, right? So
these people. And those people, whatever the hell.
Yeah, that piece. We won't get into that. But nonetheless, it was just insane that after reviewing his financial plan, and he literally just said, what are your thoughts? Now, I never did see that money for myself to kind of manage or whatever. I don't know what they've done with it. And, it is what it is. But I just couldn't believe that these people, that 20 grand was going to be a lot to them. It's a lot to me, for crying out loud. I don't think anyone on this call would turn down $20,000. But the fact that they would want to put it on black, essentially, on the casino and just hope and pray that it doubles. I guess in your mind, especially surrounding the new, I wanted to touch on the Title Protection Act in Ontario, 2019. If we can kind of segue into that and in dealing with, I guess how you wanted to wrap up the crypto piece and what your opinion is on that.
Boy, I don't know if we can wrap that up in only a few minutes. There's so much to cover about crypto, but I think that the next phase of crypto is going to be people realizing, because it is becoming, it's not mainstream yet, but it's creeping towards that. But now more and more people have gotten hurt by the last crypto crash.
Yes.
And this is where more and more people are going to be turning to say, okay, so who do I go to now when I've got a complaint? And there's no one to go to. There is no one to go to right now who has any power to do anything. And so this kind of shoots a big hole in one of the big promises that, cryptocurrency enthusiasts have been espousing, which is there's no oversight, right? It's decentralized. No one can sort of see what's happening. Well, there's also no one there to have your back. And this is where I think we're going to see a bigger push towards regulation. And the critical thing is, what is that regulation going to look at? We've already seen there's been some proposals in the US about how to regulate cryptocurrencies. That's coming from a different body than the SEC. And the chair of the SEC, I believe, just a few days ago came out and said, hey, hold on now. Some of what you're proposing is actually going to cause some bigger issues if you go about it the way that you're thinking. It's such a complex area that the regulatory landscape, which is, I think, this one of the few predictions I'll make about anything, more regulation is coming in this space. And it's going to be tough to get it right because it is such a complex field. So I'll just leave it off and say that right now there's very little oversight, recourse, or restitution available to people. And this is going to be a big factor in the next phase of where cryptocurrency and anything in that space, where that goes next.
I could not agree with you more on that, and I the irony of the statements of people, they turn to me and they say, oh, we should have more regulation, and then I turn around, wasn't that the whole point of crypto, is to deregulate the financial industry, deregulation, and that's where money went to hide. I mean, if you are, again, I mean, if you're a resident or a citizen of El Salvador right now, I mean, you've lost your shirt. That company, that country took their entire currency and used it and used Bitcoin as its official currency. And I mean, I feel for those types of people because they, under no circumstance, chose that destination for them. Now, Trev, you and I were talking earlier about what we thought was going to be the 3/4 of a basis point, 3/4 of a basis point, a percentage point, 75 basis point increase. I know you had a couple of questions regarding that for Preet and his idea. Now, Preet, we're on your schedule. We can go past. Or there's no deadline now. We can keep going. So you let us know when you have a hard stop and what your schedule is like. But Trev, go ahead. You can kind of talk on. I
was just going to say, I wish I had. I honestly, I can't even remember. I didn't make notes on it when we were having that chat about it earlier. Refresh my memory.
Have a hard stop, Preet, before we got kind of
actually that's really good.
I can go to 3:15.
Okay, great, perfect. So just regarding, like, I guess, when is this going to stop, Preet? When is this? What is your opinion initially on? Did you think that the central bank took too long to start doing these? Do you think there's a world of pain coming for people that are? I mean, Trev, what is the 5-year fixed break rate typically?
Sorry, right now, the Scotiabank went up to 5.44 last night. As of 11:59 p.m. into this morning, their 5
and the average 5-year mortgage breaks at how many months? 33.
Oh,
months?
Breaking, 33 months. 70% of Canadians are breaking at the 33-month mark.
So, Preet, go ahead. What is your thought? And Trev, you can have that prompt discussion.
My thoughts in terms of the central bank reaction and sort of
Yeah,
policy in the last little
recession,
while.
that kind of stuff.
Yeah. So there's, I guess, if we go back a little bit to the 30,000 foot perspective, there are basically two camps. There's team transitory and team structural in terms of, where is inflation going? How long is it going to be here? And the early talk was, of course, I think famous now that it was transitory, right? That thought, inflation is going to run hot for a little bit, but it's going to come back down. And a lot of that was predicated, I think, on supply chain issues. Because if we go back to March 2020, this set off a cascade of events. The world ground to a halt. And so supply chains basically had this big pause put on place. And it's taken a long time for that to sort of matriculate throughout the system. And it's basically turned into a lack of supply. Um, all these just-in-time manufacturing processes, which were the pinnacle of efficiency, fell apart when the parts that they needed to assemble things didn't arrive just in time because they weren't available. So we saw a lot of increase in prices across the board for a lot of things. As supply chains start to open up, team transitory, they've got egg on their face, and they've kind of lost a lot of credibility. Janet Yellen came out and said just recently, yeah, we got it wrong. And so they've got a bit of a credibility problem, and the market expectation is, yeah, you got to increase rates a little bit to keep inflation under control. That's historically how things work. And in the back of their mind, I think they still think, well, it really is still more of a supply chain issue. And then we had the invasion in Ukraine, which has impacted energy markets, has impacted some basic commodity markets, food markets, etc. And so it's easy again to look back in hindsight and say, the Fed should have raised more aggressively. But I think you could also say, the Fed could have raised before inflation even started to creep up. Once they realized the reaction to the March 2020, the first year of the pandemic, things were going okay. We didn't see huge, drop off in people spending money. We saw people building up savings in that first summer, if you remember that. I think the Bank of Canada came out and said the average household is now sitting on, an additional average $6,000 because they couldn't spend money on travel. And so they've been spending it on other things. So it's possible that they should have started raising rates before, even the talk of the recent increase in inflation started. It now seems, with today's 75 basis point increase, and some people saying, they almost got to 100 basis points because now the Fed needs to rebuild a bit of their credibility and, act swiftly and decisively by getting ahead of, this rate of inflation. And so I think, markets are pricing in that we're going to see a series of, double hikes going forward, which means for households which have gotten used to cheap debt and, are maybe stretched, if you combine the severe increase in the price of, getting places with fuel, cost of heating homes, cooling homes, energy, the grocery stores, plus now interest on all their variable rate debt at the very least is going up, and fixed rates when people renew into them can be so much higher. Boy, that's going to be a very tricky situation to manage, to say the least. So, yeah, I think, a bit of pessimism. I think the thing that stands out to me about this is that we've got an entire generation of consumers never seen any type of recession, true bear market, downturn. And it's unfortunately a lot of people at the margins are going to get really hurt by this.
No, I totally agree. Trev, do you want to maybe chime in here on that and what you're seeing and even the mortgage stress test piece?
Yeah, exactly. Yeah, like one of the things that Curry and I were talking about earlier today is just around bond yields, where they were, the current level that they're at. The last time we saw them at this level, we were sitting in January 2008. Right. So lots of, some comments that we were making is obviously at that time in the mortgage business, there was no mortgage stress test. OSFI realistically isn't going to be doing anything until December. But, you've got a lot of people kind of in that holding pattern, essentially, right? Where they don't have much choice. We're qualifying. That Scotia rate that I used as an example is 7.44% that we've got to use now. And it's kind of scary that because of the rising rates and the way we qualify consumers, they are actually qualifying for more of a mortgage by taking a variable rate than if they opt to take a fixed rate. And that's a pretty dangerous position to be putting people in just so that they can get themselves into the market. So more a thought than a question, but that's really what I'm seeing from this side of the business.
And Trevor, a question for you, because this is more your expertise. When it comes to variable rate mortgages and the split between adjustable rate and variable rate, what is the split like for and for listeners? What I'm asking is, when there's a change to the overnight rate, some variable rate mortgages you'll see your payments adjust, in others you'll see your amortization increase. What is the split for people? Do you have a rough idea?
No, I can't really put a percentage on it because a lot of people will say that it's the banks that provide true variable rate mortgages, and it's the monoline lenders and credit unions that are providing the adjustable rate products. However, they're really to say all of the banks provide a true variable rate mortgage is actually an inaccurate statement. Most of them I guess I could say 50-50 are adjustable versus variable. So if we were to actually look statistically, I would say we'd probably be more, again, I'm throwing a number out there just based on knowing where my volumes are and what I do and knowing colleagues within the brokerage. Pre-increase, at least 70% probably sit in the adjustable rate market, which meaning the payment is non-static. The payment fluctuates as variable moves. And then probably 30% that are in that static payment situation where it affects the amortization on the tail end.
Wow.
I mean, I'm just. Go ahead, Josh. Go ahead, Bondo.
No, I'm switching gears. So if you're on topic.
Well, I was just basically going to say, like, I know a lot of people use their home equity line of credits in order to get through the last, 2 years. And a lot of consumer debt is on those home equity line of credits. And, Trevor had a great quote earlier today. And, yes, default rates in Canada are less than 1%. And as a matter of fact, probably less than 10% of 1% historically. But Trev nailed it when he said, just because Canadians haven't in the past walked away from their homes or their mortgages doesn't mean that they won't do that in the future. Do you have any comment or any, insight onto that on what you think the status is
I think they did in the 80s, right?
Yeah. Like, Preet, you're in downtown. Are you in Toronto right now or
right now? Yeah.
GTA. So, like, I mean, pricing in with those homes are coming down. Collins was basically saying that earlier on. Like, what are your thoughts on that? Like, are you thinking that people are still going to be able to afford it, or what are your thoughts? So, do you think that monetary policy is going to have to do a change?
Well, I guess that's $1 million question. My crystal ball is always fuzzy. I always say that there are two types of forecasters: those who don't know and those who don't know that they don't know. And the flip side of that is, I think people are very adaptable. And so, if situations and circumstances changes, you'll see what they end up doing based on their priorities. So, I think a lot of people will end up cutting back on, life and enjoying life to be able to make those payments, because I think it's kind of been burned into our minds. Home ownership and not missing mortgage payments. It's like one of the last payments you miss if you can, right? And so I think that's going to have the effect of stretching some people, and they'll be able to maintain their payments, but they'll have to make sacrifices in other areas. And there will be some people who will have to make some tough choices. I mean, if you take a look at the tech sector, we're just starting to see some waves of layoffs. You know, certainly starting in the crypto space, but we're starting to see it sort of trickle through to some other in the high tech space. And when you lose your job, I mean, that's when it may be a recession. If what's the saying? It's a recession if people around you are losing jobs. It's a depression if you lose your job.
Right.
And that's when you'll start to see people making hard choices. There was a survey that came out. It said something like 1 in 4 people would have to
Mhm.
sell their homes in the face of rising interest rates. I don't see that. I mean, that I'd like to know more about the exact wording of that question. That doesn't strike me as um, plausible, unless they said interest rates rose by a certain percentage. But 1 in 4 homeowners, that doesn't sound right. So
They're pretty stretched right now, though, Preet, right? Like you see a lot of, and Trevor can speak to it too, because he's got to qualify these people. We deal with them on the back end. You're seeing so many times a parent come on, right? And I mean, at the end of the day, the parent's just on really to help them qualify, right? They don't want to dig into their pockets. And, we put bearer trust agreements behind the scenes saying, the parent doesn't really own the house. They're just there to help them qualify, right? So, I mean,
but what would happen? Let's say we do have a significant enough increase that there are enough people who start to default, and there must be some kind of restructuring option. It might be painful, but if you're a lender and you have a lot of people who are at risk, I'm sure part of your business calculus would be, okay, well, let's allow them to restructure. Maybe the penalties or the fees for restructuring will, cut them a bit of a break, because we're going to end up making more interest in the long run anyways. There's got to be some kind of mechanism. I don't think people are just going to sit by and watch people default and bail in their homes because en masse, because if that happened and you had this big selling pressure, keep in mind the percentage of people working in real estate related industries now is, I think, something like 3 or 4 standard deviations away from the long-term norm, because the housing market has been so strong for so long. It's attracted people in. So that's a sort of like a rational response to that. Go where the money is being made. But that also means that the economy is a little bit more vulnerable, because if there is, some kind of significant destabilization in housing, then more people are affected, which then becomes this positive feedback cycle. All those people working in those industries make less money. They're able to make less payments towards whatever they spend money on, and so on and so forth. So I imagine policymakers, industry, if push comes to shove, and we've seen this happen before in crises, they'll come together and figure out some kind of solution. So there is that sort of, adaptability variable to always think about. You don't want to rely on, just assume that, people are going to get bailed out and industry is going to get bailed out. But I think that is always something in the back of people's minds that, if things got really, really, really bad, people are willing to change, I wouldn't say the rules, but they're willing to make sort of take extraordinary measures.
Yeah, and I mean, even if you look at a lot of times when somebody's going through an unfortunate situation and it's a bankruptcy or some form of insolvency, or they're going into some form of creditor protection, a lot of times one of the last assets that they're going to lose is going to be their house, right? Because they preserve that payment and they stay in good standing.
Yeah,
it's their largest asset a lot of times, right?
Yeah. It's scary right now. That's for sure. I mean, it's definitely going to be, I know a lot of people that are, they put a lot of those trips and those, a lot of, how can I put this? Yeah. A consumer debt, basically consumption debt on their home equity line of credits because it was so cheap. I mean, we had back in season 1, the amount of people, his name was Alex DeGenis. He was the owner of Henley Honda and Subaru of Niagara down here. I mean, subsequently, he's sold those dealerships. But at the time, he basically was saying he could not count how many people walked away from a fixed loan from the dealership at like 0%, zero, or maybe 1.5%, whatever, and put it right on their line of credit. And because they only had to make interest only payments. And he goes, boys, do you remember that? He was very passionate about it because he's right. A structured loan.
Yeah.
You pay it off by, 5 years, 6 years, 7 years. And I believe
at 0%. at
Yeah,
0%, right? Like
And
that's
Preet, if I'm not mistaken, you did something on the 7 or 8 year. You did a video on that as well. That being,
Yeah, I did. Yeah, very quickly, it was looking at 0% vehicle loans,
That's right.
and whether or not they're actually 0%. Because sometimes what can be the case is, if you go to a dealership and they say, "Hey, this car is 30 grand or whatever," and if you're getting a loan, they'll say, "Oh, well, we can give you a 0% loan," or if you're gonna, pay cash, we can give you a cash discount, which means the true price is the cash discount price. And
it's
so
built
it's
in, eh?
0% of a higher principal value, which is kind of an artificial principal value. So it's not really a 0% cost of borrowing in the grand scheme of things.
Creative
Right.
accounting.
Yeah.
it was also a great little video too. Also, there was a good one on should I buy or should I rent? That was another good one. Anyway,
I got a couple questions for Preet there. We kind of sidetracked it there, so just because I wanted
Go
to
ahead.
address your question on the line there, Brendan. So,
Yep. Go ahead.
Any interesting results, Preet? Obviously, you're not. I don't expect you to spill the beans on your UK study, right? But I don't think you've gone to print yet or anything, right?
No, I haven't defended it yet. I have some early sort of thoughts that I think that are emerging out of the data. The biggest one is there's probably more of an endogenous factor that explains how well people end up doing. And what I mean by that is it's clear that, people with higher income, higher levels of wealth, before selecting their primary channel of advice, there's probably something about those people that is largely explaining why they end up doing so well. And so in many cases, they go to a channel of advice, advisor or not, because they've determined that they need help with something. There are certainly situations. One of the things we asked about was, who solicited who in the formation of that relationship. Was it, someone convinced you to work with them, or did you decide that you needed help and you sought advice? So we try to tease out who is responsible for making ultimate decisions. Another variable we looked at is who is responsible for actually implementing the things that you did. For example, did you decide that you wanted to save a certain amount of money per month and you just needed someone to facilitate that? Or did someone say, you want to save 200 a month, you need to save 1,000, and they actually got you to save that extra 800? And so what seems to be the case is that there's probably more about the individual that explains how well they end up later in life than necessarily the channel that they go to. But the other main finding that looks to be emerging is that the one big differentiator between any advice provider is how much they focus on financial planning or being holistic, as opposed to just looking at any one thing like just a portfolio or just insurance or whatever. And so as a measure of someone's financial well-being, which is kind of like a more holistic way of looking at what they're getting, those who are providing financial planning or financial planning related types of services is where the value seems to be.
Yeah, I would imagine that would extend to estate planning, right? Which
yeah, I mean, it basically comes down to, goal establishment, creating plans, monitoring, reviewing plans. It's really about the process as opposed to
100%
product.
Yeah, the relationship and the communication that's had between the advisor and the client, which is always key. When did you fall in love with numbers? 87? Was that the year?
Why do you say that?
I just noted on your bio there that you had part of a championship-winning team there, math team in '87. So.
Yeah, it was a totally unexpected win. We really thought, we didn't place at all. They were at a third place, second place, and we're just like, all right, where are the muffins? Let's just start eating or whatever. And then they mentioned that our team won. We didn't believe it, so maybe there was some miscounting involved, but. I like
that
numbers.
Would be funny at a math challenge.
Yeah, right. I like numbers. I wouldn't consider myself to be, like a mathlete really. But I like working with numbers and analyzing data. I definitely like spreadsheets more than the average person. That's for sure.
Oh, I'm with you. Oh my God. Yeah. Love the Excel sheets.
Yeah.
Love them.
I
But
wanted
in the
to
time,
tip my hat to you. I wanted to tip my hat to you too, just about your honorary involvement in the Better Life Foundation. All of us
Oh, yeah,
here are
thank you.
involved in charitable organizations and helping, somewhat less fortunate. So we tip our hats to you.
Yeah, it's a
for your
great
involvement with that.
organization. I'm not involved with them anymore, but they're based out in BC. But they had this great program where they provide meals for people who are on the margins of society, and I just need that break. And think about any day you started out where you missed breakfast, you missed lunch. How productive are you that day, right? You're not performing at your best, and that's your status quo. Imagine how hard it is to break out of whatever situation you're in. So they do a lot of great work.
well, thank
I've never
you.
seen a car go with no fuel, right?
There you go.
Exactly.
Nice.
Well, knowing that we're pushing up against your time, we want to say sincerely thank you very much. And when you do produce that paper and you defend it, we would love to have you on again. The power of Zoom is you can be anywhere in the world, and we'd love to have you on again to discuss it.
Even if you're in the UK.
Yeah, 100%. We're good. We're good to working with you. We really appreciate your time, as we know you have a finite amount of it. If you want, we do give our guests, our sponsor, Brand Boulevard, gives our guests a nice little takeaway. So if you want to, that little mug, you get 2 of those.
Ooh,
so
nice.
It could be a his and her. Just afterwards, you and I,
Just like all
you
of
and
our
I-
wives.
Yeah, that's right. Afterwards, you and I can connect, and you can just tell me the post office box or wherever that they can send it to. Everybody, please go to preetbanerjee.com to find out more and to subscribe to his YouTube channel. I do. We all do. It's been amazing. He does great
Also
advice.
has a podcast.
And a podcast. Sir, thank you.
Thank you,
appreciate
gentlemen.
it.
It's been
it was very enlightening.
Help us, help
It's
you.
been a pleasure.
Go ahead, Bondo.
Greatly appreciated. Help us, help you stay informed.
Thanks, everybody.